Welcome out to Tackle Trading's halftime report here on Hump Day. And on Hump Day, I always have the absolutely amazing options wizard, technical master himself, Tyler Craig. Tyler, how you doing here today?
After that introduction, I'm feeling pretty good.
I'm going to work on that introduction for next week, and I'm going to go at least 30 seconds in all the amazing things about you. That's what I'm going to do, Tyler. I love doing intros. They're fantastic. Well, Tyler, here on the Wednesday, we got Fed Day here today. But before we get into what is all the under things that are happening in the market here today, welcome out to Tackle Trading's halftime report, guys. Hit that like and share as you enjoy the program here today. We got a lot to cover, from the Fed and the Fed's expectations to what is happening from an earnings perspective here today. Got some good little bottoming formations happening post earnings on a couple different plays that we're going to discuss. And then later on today, we're going to also get into another edition of Jedi Options, where Tyler's going to debate with me and with all the community a bull call spread or a bull put spread. Do we want to do delta? Do we want to do theta? It's a conversation we have all the time as traders. Looking forward to another edition of Jedi Options. And if you're new to Tackle Trading, make sure to hit the subscribe button on the YouTube channel. And if you enjoy what you see over here on YouTube, just wait till you see what we do in the pro member community. You can always get a 15-day free trial by going over there to tackletrading.com. Tyler, with that said, first and foremost, let's talk about the market from a technical perspective here, Tyler. What is your technical read in the market?
Yeah, have you guys mentioned this was the best October we've had in like 6 years?
I think we might have mentioned it a couple times.
Yeah. Well, and maybe it's because the market kind of demanded that you perk up and pay attention.
Mm-hmm.
Part of it too, though, is happenstance, right? Like sometimes it's just a little bit of randomness in terms of, well, we ended at a low point in September, so you had a low beginning to October. Regardless, anytime you get a stat like best October in six plus years, it tells you something about the sentiment and the bullishness surrounding the market. And it has not let up the last couple of days either. I would have thought actually a couple of times here you had some potential reversals, but bears simply don't have any firepower right now. And today, look, I've been watching this, I think, all morning long, and we've ping-ponged between negative 0.10 and like negative 0.14 for about 3 hours now. And so there's just nothing going on the index level ahead of this Fed meeting. Market isn't spooked, nor do they maybe want to press their bets as far as the S&P goes ahead of this number. So we'll see, but so far, same old, same old.
Well, and like I said, it's been an amazing October, but really over the course of the last 3 weeks after that reversal that we saw, the head and shoulders formation, you broke back up above the 20, you broke back up above the 50. From that point on, you've just been a robust, nice little bullish trend. But over the course of the last week or so, you are, I don't want to say you're slowing down, Tyler, but any reasonable technician would say this is most likely slightly overextended at best and very overextended at worst in terms of its short-term price movement. When you see a market that is, from a psychological level, building momentum, you're seeing themes build, but you're also on the back half of an 8-9% movement from the lows without some degree of retracement, flag-based pattern, or some degree of consolidation. How do you approach that when you have this bullish theme developing in the market where bears just don't have any leg to stand on, but you're also overextended in the short term from a price action perspective?
Well, I think number one, you don't force it. We saw some areas pause and pull back here, even though the index level has been drifting higher. Some of the names that were really hot, like I'm thinking like solar, which had gone gangbusters, had a deeper retracement. So you've seen some profit taking in areas underneath the surface, but other areas have picked up the slack, such that on balance, the index really hasn't moved much. For me, it's like, well, take your foot off the gas pedal if you're looking for a bull trade on the S&P. There's just you need a reset here. But what has been interesting is you've seen other areas take off while this has paused, right? So for me, it would just say look elsewhere. If you're looking for a new trade, there's not a new trade on the S&P. You need a reset. Look elsewhere, like small caps, which we'll get into in a second.
We'll
or I can
definitely
look at
get
it
into
now.
that.
Yeah, but that's the interesting / really bullish thing about the market is last 3 days, S&P has been actually, I don't know. Yesterday was pretty robust, but small caps have gone bananas, and so you've just seen other areas wake up while this area is resting.
Well, and another thing, when you're looking at the S&P, I do, even if you had your RSI up there on your chart there, do you have a quick study you can add RSI just to kind of show the indication of where RSI is relative to the S&P 500? But when you're looking at your RSI here, you're above the 70 handle at this point. You're overextended. It's the first time you've really been in that area for quite some time, and so you do have that philosophical view that, yeah, the run's been amazing, but we are a little bit overextended. And again, not massively, just a little bit overextended, a little range up. You certainly could expect a little bit of consolidation, maybe even a little bit of profit-taking sessions. But when you look at some of the sectors, take a look at consumer staples, for example, XLP, you're not overextended in XLP. You're breaking out here today in XLP. There's going to be trades there. Even with the market overextended, doesn't mean everything is overextended in the marketplace. When you look at finance, for example, one of the hottest sectors in this time frame that we've been talking about, the market being overextended, finance has been a leader in that, breaking out of the all-time high, establishing a momentum trend. And now you look at the consolidation. I don't have an overextended view of finance here. If finance breaks, I think we all want to play, right?
Yep.
When you take a look at basic materials, when you take a look at energy, when you take a look at a lot of the when you take a look at the sector level, I don't have that same view of the market being overextended the same way I do when I look at the S&P 500 itself. And so there's always going to be those opportunities. And I just wanted to bring that up because when you were talking about the market being overextended and there's other opportunities, there's always opportunities in the marketplace. You just kind of, again, apply that top-down approach to the market. But what were you going to say, Ty?
Well, that's why it's nice to have a broad list of stuff to look at, right? That's why short-term traders like to build these watch lists and have multiple products to trade.
Yeah.
Because look, you could just say, well, chill out and do nothing on the S&P, but do you want to do that for 2 weeks? Like it may be a couple weeks till you get a really fat pitch. And so in the meantime, yeah, you got to go hunting elsewhere. So totally agree.
I'm going to tell you, there's some bottoming patterns happening post earnings that are certainly interesting, and I believe you have one of them for Jedi Options here in just a little bit. But let's get into the other indexes for a second. Tyler, regarding the S&P, I really haven't seen much difference from a technical perspective within the Dow Jones, within the actual NASDAQ itself. All three indexes doing fairly similar things, just fading towards the top end of the channels. But in the small cap index, Tyler, you're the small cap king. Everybody knows it at Tackle Trading. You literally built a cash flow condor system on the Russell 2000. You love the small caps so much. Small caps here just finally, after 8, 9, 10 months of consolidation, breaking out of the 2300 level earlier this week, consolidating for 1 day, only 1 day, Ty. We only got 1 day of consolidation at that top end of resistance, and then it blasted through here today here, Tyler. We've been talking about the Russell 2000 recently, calling it the best opportunity for the Russell to break out since the neutrality began, the best technical patterns. We literally talked yesterday about you have to make adjustments to the bear call side of the equation because of the momentum we're seeing here on the Russell 2000. But again, you're the small cap king here. What is your read on the Russell 2000 here?
Well, I think a couple of things. One item would be, if you wait long enough, eventually every area of the market will have its day in the sun, right?
Yeah.
And we've been waiting a long time in small caps, like a long time.
Patience plays on this one, no doubt.
So forgive us if we get a spike to football and get a little excited here. And yes, you can come back at me and be like, well, look, dude, if you call a breakout for 6 months, eventually you're going to be right. That's true. But to have the patience to be able to capitalize when it comes, that means something, right? That means something. So yeah, this is the area where you say overextended. What are you talking about? We've gone sideways for 10 months. This is the rotation you've seen this week. While the S&P 500 has been a little extended, this thing's waking up. What I love about it so far is it was really obvious. Like sometimes you don't really know what's going to happen on the chart. But other times it's like, look, it's pretty obvious what this thing wants to do. That bar a couple of days ago, just textbook, right? I mean, volume was above average. You took out short-term resistance.
No sell day.
No sell day. You opened at the low of the day. You went up all day long. You jammed into the close. It's like, how much of a clearer signal do you want that a breakout is likely? And so far, so good, right? So far, so good. Hopefully the Fed doesn't come in and disrupt this. But even if they did, you're telling me you're not interested on a dip here? Like, this is the best it's looked in a long time. And lining up perfectly with seasonality, right? Yeah. Like November, December, we hinted at that, you know, I know in earlier weeks when we talked. So I love it. It's strong. It looks great. I love the relative strength. I've been waiting for this for a long time. And I mean, at the risk of getting too far out over my skis here, long-term time frame, this could just be getting started. I would love to see some outperformance.
That's kind of my question here, Tyler. You know, there's this old saying in trading, and you say it all the time, the longer the base, the higher in space. Well, we've had a very consistent base here on the Russell 2000 really since February of this year. You're talking 10 months here. We're just breaking out here, Tyler. When the Russell 2000 has broken out of longer term analysis before, oftentimes we see a pretty decent trending environment in the Russell 2000. Do you see this as a legitimate breakout on multiple timeframes? It has, and again, there's always variables, Ty. Fed is a variable later on today. There's no doubt about that. We're going through a lot of political situations. There's dark clouds out there. There's no doubt, but there's those same dark clouds last week, this week, and we're still seeing the breakout. We're still seeing the no sell days. We're still seeing the momentum. Is this a breakout that you believe has legs behind it?
Yeah, I think that you have to.
I think you have to as well.
To bet against it, it's like based on what? I don't know. Like you can come up with any hypothetical you want, but based on the strength and the price action, and based on this being such a better entry point than chasing the S&P, if I had to pick one versus the other, I would 100% pick this.
Okay, and if you want to know the true opinion of a trader from a directional perspective, put them on the spot with their cash flow systems. And I'm going to put you on the spot with your cash flow system the same way I did Coach M yesterday. Cash flow condors is something that is a premium system for you. It is something you build. It's something you apply all the time. Cash flow condors is a iron condor system where you sell a bear call on the top side, you sell a bull put on the bottom side, and as long as it stays within the ranges, you're cash flow positive there, right? Yep. And you have massive ranges here, Tyler. With the breakout we saw of 2,300 earlier this week, with the continuation breakout we saw of 2,350, 2,360 just today, those bear calls are being threatened. What would a trader do with this type of price movement to the bear call side of the equation?
Well, the answer is you have to do something, right? I think that if you're responsive to the market and you're adaptive, you have to do something. Now, whether that something is take off the bear calls completely, or whether it is add hedges, I think it's up to the individual, right? Obviously, if we just keep ripping, you're going to wish you just took off the bear side because you've had 10 months of easy.
Well, and that's what tells me how much you like this breakout. Would you take it off or would you adjust it to up and out? So a typical adjustment strategy to a credit spread would to either adjust the distance between the current equity price and where you've sold that strike price. So you adjust it up. And sometimes if you need to buy a little bit more time, you adjust it out, adding more time frame to it. Or two, if your opinion is this is a legitimate breakout that has legs, one of the best scenarios just to take the loss on the bear call and take the directional risk on the the Russell standpoint?
If you're that bullish, yes,
Yeah.
100%. Because odds are you're not close to your strike, or at least you weren't yesterday or the day before.
You
So
are
the
now,
loss
though.
should have been very minimal on the November trade for sure. For me, I own IWM. I had covered calls. I took the covered calls off, so I'm just uncovered on the stock. So I kind of have a natural hedge there.
Yeah.
Yeah. Look, if you're lucky, and if you thread the needle, maybe we end up being, we go up enough to where I can make money on IWM, but not so much that I lose on the bear call. It's always tricky though. But yeah, this I think is the most obvious, maybe biggest signal that you've seen to do something probably in 10 months.
No, I certainly agree with that, Ty. And traders talk in code. And one of those codes is if you open up that risk graph on a covered call, it's because you like the directional price movement. Your projections have to be higher than that. Same thing with the bear call side. Tyler, thank you for that answer. I really do appreciate
Can I say
that.
one more thing on that, Matt?
Yeah, of course.
Yeah. The true test of whether you managed it right is like if you hedge, did you make more money over the last 3 days on the hedge than you lost on the condor, right? So if you didn't take off the bear call and you tried to make an adjustment, how have you fared over the last 3 days? Because you've seen a big up move, a big an adverse move essentially for the condor. How well did you fare? Or just today, right? And in my situation, I can tell you that the hedge has gone up more in value than the condor has gone down. And that is like proof to me that even though in hindsight, maybe I didn't make the perfect decision, so far the management's been fine.
Oh, I think the right decision was to uncover on the breakout of 2,300. I truly think that was the right decision. And so whatever happens next, I don't think you go back and microanalyze the decision that you did make, because you made it based on price action and not based on other factors, right? Well, let's talk about the major news of today here as we did navigate the indexes. Let's talk about the thing that can impact the indexes today, and that is the Central Bank of the United States, the FOMC, is meeting today to announce monetary policy or changes to the current monetary policy. And whereas we do not expect any changes to the underlying monetary policy today, nobody in the market does. We are fully expecting an announcement on tapering, and very quickly that those hypotheticals will become reality very soon. In about what is that? About an hour and 10 minutes from now.
So 1 hour, 10 minutes, 35 seconds.
There we go. In 1 hour and 10 minutes, we're going to listen to Jay Powell say a lot of things that I may disagree with. But what he is going to announce today is something very important, and that is tapering. And the only thing we're waiting on, guys, the only market surprise here today that can occur if we go above or below what the market expectations are. Remember, everything is a positive or negative, not based on the raw number from zero in the market, but based on what those market expectations are. You never assess earnings at zero. Did they make money or did they lose money? Is not the equation. It is what the market expects and then how they perform against that expectation. Earnings reports, economic reports, central bank monetary policy, it all works within that parameter. And right now, the market has adopted a philosophy that the Fed is going to reduce by $15 billion a month over 8 months. Now, if they come in line with that, we really shouldn't see any major surprises from a tapering perspective. Personally, everybody at Tackle knows I'm a little bit of a hawk. I'm a little conservative from a monetary and a fiscal policy perspective. I would like a $20 billion over 6 months, but 15 over 8 makes some sense as well. It's about the ending time frame here. We're widely anticipating the Fed getting done with tapering by the end of the second quarter of 2022. The open questions we have for the Fed today as market participants are very simple. Number one, is it 15 or 20 billion? Because it better not be 10, Fed. Is it 15 or 20 billion? That's kind of the question I have, 15 or 20. but it's really about the language that is going to be pertaining to the inflationary conversation we as market participants, and quite frankly, we as Americans and people around the world have been having over the last year. Is inflation transitory or is it not? Now, we at Tackle Trading, we are of the opinion, and we have been of the opinion from the very beginning of this conversation over a year ago, that the inflation is not going to be transitory, that this is going to have a long-term lasting impact on consumers, not just here in the US, but abroad as well. Over the last month, we have seen the Fed come off that transitory language. They're now starting to adopt that inflation is going to be a little bit longer term, a little bit longer lasting. Now, why this is important is if the language of inflation does in fact change, the market could assess that as being a little bit more hawkish and thus have to update the projections on interest rate policy, not for today. We know what's happening today. It's about what happens in the last 6 months of 2022. Remember, from 3 weeks ago, from 6 weeks ago, we're looking at the Fed dot plot, which has never been accurate, but it is an important tool for the Fed watchdogs. We're looking at the Fed dot plot, and that's suggesting 1 to 2 interest rate hikes in the back half of 2022. If the Fed is assessing the inflationary environment as more concerning than what they have been assessing it over the course of the last 6 months, and they thus start removing any philosophy towards transitory, the market could anticipate that as a higher interest rate projection in the back half of 2022. These are not major concerns, honestly, for market participants today. I just want our community to understand what we as market participants are looking for the Fed today. And number one, it's an announcement on tapering. And again, I said this yesterday, I said it a month ago, the Fed has simply ran out of time with tapering. They have to taper. They cannot watch this inflationary situation and continually pump $120 billion into the financial markets that is not wanted, that is not needed, and has not been wanted or needed in over a year. It is time for the Fed. It is time for the Fed to act there. That's number one. Number two, transitory language regarding inflation. I do not expect Jay Powell to talk about transitory. I think he's going to accept inflation as something they need to attack. Let's see how the market responds to that. Stay with us tomorrow as we break down the Fed action. I will have my initial thoughts in the Tackle Trading Discord channel in the Mastermind group, but I will be here tomorrow to break down all the Fed action. But that's what we're looking for today, Tyler.
So the question I would have, that $15 billion number, did the Fed float that out, or that's just the market
Fed floated
consensus?
it. Okay. The Fed hinted towards it, but again, what the Fed has really just told us is they want to be done by the end of the second quarter next year. And so if you look at that from now, if they announce it today and they start in November, the most likely scenario is 15 billion a month. That's the most likely scenario because that gives you 8 months to get that done. If they start though in January or December or January, you're really fitting a tight window, and that's $20 billion over that same time period. And so you're still talking about the exact same end goal, whether you start today at 15 billion in November or 20 billion in December or January, you're still getting done by the end of the second quarter next year. And so honestly, it doesn't matter to me whether it's 15 or 20 billion. It really doesn't matter to me because again, the end goal is the exact same. You're getting done in June of next year. It's really about how aggressive they want to go about that. But the most important thing, Tyler, and I think this is what most market participants are looking for, is what does Jay Powell have to say about the inflationary environment? We've seen some really nasty projections on inflation, not just here in the US, but around the world. We've seen some fairly concerning inflationary projections. And the simple reality is this, and I've said this for a long time at Tackle Trading, but the Fed has been wrong for 18 consecutive months on their inflationary opinion. They have been absolutely fundamentally wrong. And by removing the transitory language from inflation, that proves how wrong they were on inflation. And so it's going to be very interesting to watch Jay Powell dance the dance that he is going to have to dance today around that inflationary conversation, because that's where the thin ice is right now. That's Jay Powell's walking on some thin ice. Well, it's the inflationary conversation that he's walking on. So I'm looking at this again. Tapering to me is, so what? You should have done it. You should have done it 2 months ago. It's not needed. Just get rid of it. Let's move on. It's time to remove the tools from the marketplace. I've had that opinion for a while now, though. To me, it's about the inflationary conversation today. And if they do nothing, like just get out. Just he gets no more term, none. Out of here. You're fired next year. Get out. So it's going to be interesting to see how he walks that line on inflation. But again, that's what we're all going to be talking about is the removal of the transitory language and exactly how does that impact the Fed dot plot with the anticipation of interest rate policy moving forward.
Good summation, Matty. I love it. I love it.
That was the rapid fire style of what I had to say about the Fed.
Listen, again, I didn't know. Here's how you know that was good. I haven't been keeping track of any of this, and based on that, I understand now what matters, what are the numbers, how we got the numbers.
And that's all that's important. And that's all that's important. Although I'll have some opinion on it a little bit tomorrow too.
I'm sure you will.
A little bit tomorrow too. But let's get into a little bit of commodity talk here, Tyler. Let's talk a little bit about crude oil here. Crude oil fading a little bit as it navigated that slowing momentum. 85 held yet again. We've talked about it. Crude oil got a downgrade from us at Tackle Trading over last week. We downgraded. One of the only downgrades we had in the market was based on slowing momentum in the energy sector as well. And a lot of what we're seeing over the course of the first 3 trading days of this week is because, and not because we downgraded, but we downgraded because of these reasons, the shifting behavior, the shifting characteristics from a trending perspective, and the shifting of momentum. Tyler, is today something of a little bit more concerning to you, though, than just a loss of bullish momentum? Because it seems like the bears are picking up steam a little bit here.
It does indeed. I mean, if we say we close here, close below the 20 MA since this whole party started in early or late August, that's a change in character. If you broke this call it $81, that would complete a short-term double top pattern too.
Give me an hour chart on that. Let's dial in that level of support here. Look at that. Look how clean that support level is. That violates. I think you got to shift your bias even lower than where it currently is.
Yeah, and what does that tell you about the types of charts you're going to see in the energy sector? They're just going to be messy. They just need reset. And so I think if you still like energy, you're a buyer of the dip at some point. It's just a matter of how much evidence do you want, that the dip is getting bought and so forth. So
I want to see it get through the Fed day,
sure.
Right? That's kind of where I'm at right now. I want to see it get through the next hour and a half. That's what I want to see. You're at that point on the chart where you're like, yeah, you're a little bit concerned if it violates, but that level has held for an entire week. That level has been tested multiple times with similar volatility, mind you, as well. You've had some heat coming into that support level before. You've held that support level, and so you're going to bet on support until support violates. There's no doubt about that here. I still look at crude as neutral. But we got a major event coming up in an hour from now that's going to have something to say about this crude oil chart. So I kind of like, I still like energy. Like Devon reported here today. If you go look at DVN for a second, Devon reported here today, looks really good above the breakout channel. Obviously, it's going to be volatile. It's earnings day for Devon, but you still have really good plays in the energy sector. There's no doubt about that. Those plays are still legit if that support level holds. If it doesn't, you're going to see a little bit of increasing volatility. And the Fed in an hour is absolutely going to have something to say about commodities. They might not talk about commodities, but if the entire conversation we're all anticipating today is a conversation on inflation, Well, what market has that inflation that inflation baked into it? It is the commodity market. And so the commodities are going to have an impact here. I expect some volatility in the commodity market today. I expect more volatility in the commodity market than I do the actual equity market here today. Now, with crude oil kind of kissing up against that support level, let's take a quick peek at gold very quickly, Ty.
Ay, ay, ay. Doesn't look good here, Matt.
No, it's gross.
It's gross. It's gross. This is the worst day gold has had in over a month. Yeah, man. Look, I don't like this chart at all.
Well, but
It's
why?
unfortunate.
The question is, why don't you like it though? Because you didn't like it not because of today. To me, you didn't like it because of 3 days ago.
True, but it's worse.
Oh, it's getting ugly.
I
And
mean, yeah,
price
it's like we
projections
haven't
have been
loved gold
lower.
for a while, but you at
Yeah.
least could have made the case that, oh, you're showing some spine here, gold. Even had some nice accumulation days over the last month, but no, that today kind of invalidates this whole short-term
Yeah.
uptrend attempt. It's not pretty.
It is certainly not pretty. What about Bitcoin here? Bitcoin has taken on that bullish inflationary digital conversation over the last 6 months or so, looking at a little consolidation at that top end of the chart. Tyler, I've called this a bullish retracement. I've called it confirmation. I've debated that with a couple technicians here in the halftime report, but technicians are always going to debate the pattern to a certain extent.
Yeah.
What is your read on Bitcoin? Haven't got your read in the last week. Last Wednesday, we kind of found a low price, Tyler. Today, what's your read?
Yeah, look, I mean, in an ideal world, you would have had 6 green candles right up to 70K off the bounce. But look, I mean, you've been spoiled, okay? It doesn't always go up 30 grand in a straight line.
Oh,
I
come
don't
on.
I don't
I
mind
want to
this
see
little.
the exact same price movement and ping 90 grand. Come on, let's go.
I mean, look, it'd be nice. You need another catalyst, like give me rumors of a actual Bitcoin ETF, a real one coming to market. Maybe that'll be the catalyst. But
Yeah.
it hasn't done anything wrong, right? I mean, ever since it held that 58K, it's been behaving itself, 2 steps
Yeah.
up, 1 step back. Today is an inside bar. I try not to over analyze an inside bar because we're just digesting yesterday's move. Look, would I like it to break this 64K and get a move on and get up to the pivot, make a higher pivot buy? Sure. I don't mind that it's pausing here. It's constructive. I would be concerned not to break at 58. Until then, I'll give bulls the benefit of the doubt.
Yeah, and I'm that's the same levels I'm looking at as well. And Tyler, I don't think it does anybody any justice to overanalyze any price conditions the hour before the Fed meeting.
Yeah,
Just
completely different in an hour and 10 minutes. So
100%, 100%. Let's move on here, Tyler, though, and let's talk a little bit about earnings here today, Ty. We don't have, and I've been saying this all week, we do not have the brand names that we had last week as we were dealing with Apple and Amazon and all those big blue chip type names, massive market cap type names, the type of corporations that everybody tracks. But we do have just an absolutely massive dose of earnings coming into the market this week. And today was one of the hot and heavy days. And so I'm going to rapid fire style here, Tyler, in earnings. And you are going to give me your quick rapid fire technical take on it. Sounds good?
Yep.
Awesome. Let's first start with the healthcare sector. We've been talking healthcare recently at Tackle Trading ever since Johnson & Johnson's report. We've seen that healthcare space just start to perform a little bit more consistent. And now you're talking about we're back into some degree of bullish territory. Healthcare here today, we got Amgen, we got CVS, we got Veritex. We're going to start with Amgen here coming off the lows. Like the bottoming pattern here, Tyler. I know you're going to be talking about Amgen's bottoming pattern in Jedi Options. Well, Tyler, they had some positive earnings to support that as well. Amgen comes out at 467 versus a 422. Revenue came in line at $6.7 billion. What really the story of today, though, with Amgen is the beat on EPS, but most importantly, guidance. They raised the top end of their guidance. And when you do something like that and you're coming off the low price, Amgen's been under some fire recently. Nice little downtrend. This looks like a trend reversal candidate, Tyler. I know you're going to be talking about Amgen in Jedi Options, so let's save the commentary for Jedi Options, but love the bottoming pattern happening here. Let's move forward to CVS, another healthcare giant here. CVS comes in at 197 versus the 179 expectation. They came in with a very good revenue number, coming in at 73.8 billion versus the 70.3 expectation. That resulted in a 10% increase in revenue year over year. Once again, very similar to Amgen, though, extremely similar to a lot of healthcare companies in this earnings season. What is it about? It's really not about the raw numbers coming out of healthcare. It's about their guidance numbers. Amgen raised the top end of the range on guidance. CVS, same thing here today. They raised guidance. We're looking at liftoff here in CVS here on a gap out on the weekly chart breakout. Tyler, what's your technical read here on CVS?
Dude, part of me is like, did we know at $50 it was inevitable CVS would recover? Hindsight's so 2020.
It is like, because we had the same thing on AT&T and that decided to blast. Yeah. So I get it, but yeah.
Yeah, no, I don't know.
It looked good at 50 though.
Just thinking about so processes, good. How this has come around trip, and it's like, could you have thought through this earlier? Look, this is very, very impressive. The weekly chart is gorgeous. And actually I like its pattern and history with breaking out of weekly bases. It's a good signal. Weekly chart's fantastic. The daily charts, look, this ran quite a bit into earnings. It's, as we say, it's a baller move when you run 3 weeks straight into earnings, and then CVS
and then like, you gap and run.
No, not good enough. Not good enough. Yeah, it's very, very impressive, and this has to be on your radar to buy the next pattern for sure.
I think it's all secondary pattern at this point. You've ran a little too much, and I'm with you, Tyler. I do like the pattern on the weekly chart. I think it's actually fairly consistent. But when you're looking at this daily chart, you've ran so much, and I as a technician, there's just a number that stares at me, and it's called $100. It just stares at me, right? It just stares at me. And so I could certainly see some price moving up into that range. But again, I think secondary pattern here. CVS, good price response on a good report. I think if you're looking at healthcare and you're looking at adding something to the watch list, maybe for next week, the week after, CVS could have a secondary pattern that fits that mold. Let's stay in healthcare. Don't have numbers, but I do have a pattern I want you to break down. Veritex, VRTX here. Good reversal coming on a positive beat out of Veritex. Tyler, just give me your quick technical read on this one.
Look, Vertex needed this guy needed a lifeline. I mean, it was 300 down to 175, 50% off the highs. That's a little,
it's a discount. It's red tag.
It's a little rough.
Yeah.
So kind of like the Amgen explanation. Look, anytime a company can get an assist on earnings after having dropped 50%, it's a good change of pace. I like the ascending triangle here. I like the breakout. I know this is why we were kind of looking at it. First close above the 50 in a couple of months. So it's as good as Vertex has looked in a long time. Ultimate question for me is, do you want to bottom fish? Is this your game? If it is, you got to be interested, I think, here.
If it is, I think you are interested based on what you're seeing technically. But any target above 200 here is a pipe dream. You got a lot of resistance levels there at that 200, and then you got that downward moving 200-day moving average, which is going to be in line at 200 by the time Veritex gets there. So I think anything you're looking at here is short term and just looking to play the momentum above 190, kind of driving it into that 200 level. But if this is a true reversal, and I say if this is a true reversal, the reversal doesn't happen at 190 in my opinion. The reversal actually confirms above 200.
Well, for sure. And look, long-term trends.
Well, it's the long-term that. Yeah,
they take. It's like turning around a cruise ship, right? I mean, you're not going to do this on a dime typically, and so you're right. That's the real celebration is getting above 200, change the weekly trend. For
Yep.
now, you got to be guerrilla tactics. Take your profits if you can get them.
I
if you're
like
playing
it.
this.
Let's move on and let's talk a little bit about Mondelez, MDLZ, please here, Tyler. Mondelez comes in at 71 cents versus 70 on the expectation. Revenue comes in at 7.2 billion versus 7. That resulted in a 7.8% revenue increase on a year-over-year basis, and very similar to CVS and Amgen. Mondelez had a little bit of an increase within the ranges, but technically and officially a tackle, I'm just going to call that a reaffirming of guidance. Positive response, little bit of a mixed data coming on the revenue. Positive response, but profit-taking session after the cash open, Ty. Question I have for you on this one, because I don't see a trade, maybe something secondary, but not anything in the immediate short term. Tyler, when you see a gap out, but then the fade back down, what typically do you, what thought process do you see that from a technician's perspective?
Well, I say Mondelez. Didn't you see CVS? Come on, man. Do a CVS. What are you doing?
Hey, no sell day. Come on, let's go.
Look, CVS, they bought the gap up this, they sold it. It's not a good look. Like, what do you think? You think, well, I mean, the market rejected higher prices. Remember, when a stock gaps up, you know where it's going to open. You don't know where it goes after the open. It's almost like, are they going to accept me? It's like Price is a sensitive teenager and they're going to a new group of friends and they want to know if they're going to be accepted or rejected. And Price got wholehandedly rejected here with Mondelez. Investors took the opportunity to take profits into the gap up versus embracing it. Now, maybe it's a short-term phenomenon. Maybe they start to like it tomorrow, but it casts a cloud over the whole chart, and it basically means that it needs time to reset.
Agreed.
Because it's a big red bar in the middle of nowhere. Now I have to wait a week and see what happens.
Agreed. Let's move on. Let's talk a little bit about Tackle 25. And I do say typically darling of Tackle 25. I am not going to say that. I'm just going to say dog.
Hey, Activision. I think I know where we're going. Yes.
Let's talk about Activision here. And I think Activision is going to have a short life on the Tackle 25 after the year it's at, and honestly, after the earnings report it just had. For those of you who are new to Tackle Trading, we have a fundamental list that we put out there for covered calls. It is called the Tackle 25. The Tackle 25 is, I'll put the Tackle 25 against any list in the market by any institution, any bank over the last 7 years. Activision is not a great stock for that list right now. The underlying fundamentals have changed. I never remove a company from the list based on technical analysis, ever. Downtrends, you don't get out of long-term investments because of downtrends. You write covered calls in downtrends to offset the loss, and then you open up the risk graph when it wants to break out, kind of like you were talking about on IWM earlier today. But you do get removed from the Tackle 25 when your underlying fundamentals from a forward guidance perspective gets cut in half. And that's what happened on Activision today. Activision came out.
Cut in half?
Cut in half. Tyler, the worst guidance I have read, and I have read them all in the last 6 months. I name the company.
Give me the details. What, like, are they losing games? What's going on?
They're losing games. They're losing subscribers. They're losing on everything right now. Activision comes out. Raw numbers weren't bad, but the raw numbers expectations were fairly low given what has happened with Activision. Activision comes out right now at 82 cents versus 70. It's actually a pretty decent beat on EPS numbers. Revenue came in at 2.1 versus the 1.9. That's a decent beat for Activision on revenue. So they actually started the earnings season with a beat and a beat here, which is where you have to start with. But here's what you can't do. You can't have a guidance that is expected to come in at 139, a guidance EPS at 139, and they can't cut that in half to 60, what was it? The officially 62 cents. You were expected at 139. You came in at 62 cents. You got destroyed next year.
Okay.
This is a nasty number coming out of Activision, and they're losing in every division here. Activision, the market got it right. The market got it right. You cannot come out and say to your investors, we're going to do half of what you thought we were going to do, and have the investors be like, you can't have that. You can't come through a year where you're basically going through a tremendous amount of issues. I'll just graciously label them issues at Activision, and then tell the investor class we're just not going to make as much money next year and have them stay with you. That's not going to happen. Activision's got a long haul to change course in what is happening with this company. And again, I just kind of feel like the market got it right on the gap down. This is the low price for the last 19 months on Activision, and it is absolutely deserved by Activision based on the numbers that they have came out with. And it does not look like the selling is done here on Activision. Tyler, the underlying fundamental picture is not very rosy today. What is the technical read on Activision?
Well, it's not going to certainly give you a reason to change your mind. That's for dang sure. So weekly chart, let's start on that. To your point, yeah, lowest price in almost 2 years.
It basically puked up pandemic response. So you're back to where you were pre-pandemic.
Yeah, which the narrative, I mean, everybody staying at home should have been really good for these guys. To take whatever you gained with the pandemic changing consumer behavior and give it all back sucks. Like, not a good look.
Well, and it's, again, you can understand last year the price response. You can even understand this year. I mean, if a lot of the market is going up because the economy is reopened, the vaccine and everything that we talked about in the first 6 months of the year, that's not going to be a net positive for Activision. So you can understand a little bit of the downward movement in price. What I don't understand is giving up all the gains you had from a fundamental perspective in that time frame too. That's company mistakes. That's not sector problems. That's not industrial problems.
Well,
that is problems
is,
that Activision has.
Is Activision's pain a competitor's gain or not necessarily?
We'll take a look at that. Take a look at Take-Two, TTWO here. Okay. TTWO looking at a little bit of a high base, shaking off any of the volatility that Activision had here today. And so you got to look at TTWO, and I'm saying, hey, listen, I like that right shoulder breakout in TTWO here. I don't have the same opinion towards Take-Two that I do say in Activision. And again, when you're looking at Activision, just reported today, we know the underlying earnings here today. But when you're looking at Take-Two, when do they report? They report, I think, tonight. Yeah, I think they report tonight. And so here's Take-Two, and tell me this, Ty, if this was energy and Exxon, wouldn't all energy components be down if Exxon was down 16%?
Yes.
Okay. I'm not done. If this was JP Morgan and JP Morgan's down 16%, wouldn't all banks be down 16%? Like maybe not 16, but relative they'd come down, right? Any leader in a space, when they typically get blasted, the space gets a little bit of the pain as well. Well, here's Activision, to answer your question, getting absolutely crushed here today. What's Take-Two doing?
Well, they're saying that's a you problem, Activision.
Because it is a you problem, Activision. When you're looking at EA here, Electronic Arts. EA reports, I believe, after the market here today as well. Well, it gapped down with Activision, but then what? It fired back up. And so, to me, the price response you're seeing is not a massive rejection of the gaming companies out there. It's a massive rejection of Activision and what specifically Activision has done over the last 9 months. They simply have had way too many problems within their company. They've had to restructure their company due to lawsuits for reasons that I don't want to discuss here in the halftime report, but absolutely are legitimate reasons. It's an Activision problem, 100%. They cannot get their act together. And because they cannot get their act together, why would any investor want to stay with this company right now?
I got nothing to add, dude. Stay away.
Yeah, just stay away. There's just better
Well,
opportunity.
and so
There's just
would
better
this be then the
opportunity.
final? Would this be then like the final straw that breaks the back, where it's like, look, it maybe we were sticking with, and I don't know what the exact problems were, but maybe some investors, the thought process is, look, we'll give you time to work it out, you'll fix it or whatever. And then today are like, no, no,
Yeah,
not doing it. See you
in a
later.
short-term down in a short-term downtrend from 95 to 80, for example, over a 4 or 5 month stretch, investors aren't going to leave you. They are not going to leave you. They're not going to leave you for short-term technical reasons. Not going to happen. What are they going to do? They're going to write covered calls. That's what they're going to do. They're going to write covered calls to offset that loss. Well, today, after the guidance that they're now saying, why would they stay?
Why am I sticking around? Yeah.
Like, what am I going to do? Write covered calls? Like, I kind of feel like we're just going to write covered calls to offset loss because they can't get their fundamental act together. And that's a different story for me. When it's a technical downtrend, yeah, you're just going to write covered calls because that's what we do. But when you're getting blasted based on fundamentals and your guidance is getting cut in half and you can't get your act together, and you need a change in leadership, in my opinion. So enough of the blasting of Activision here today. Let's go ahead and blast Lyft instead. LYFT here. Lyft comes in at 5 cents versus the expectation of a negative 4 cents. The revenue actually came in line, 864 versus 869 versus 864. Problem is you had a little bit of a reduction in guidance. It wasn't that big of a concern. We're not talking to the level of Activision here, but a slight lowering of the guidance within the ranges was a little bit of enough to drive it back down off the positive beat. Technically, I just see a little bit of a bottoming formation at 45 here. Probably need to work out the technical scenarios a little bit more. Tyler, what is your technical read on Lyft?
I feel like Lyft's a tough stock to trade. I was trying to think as I was looking at this the last time I did something on it. I just don't like its trending behavior. Today does nothing to cause me to warm to this stock. I already forgot the ticker. Like the other one we looked at that got sold into Mondelez. Not a good response, man. You got rejected. The crowd does not like you right now. So you need a reset. And I don't know, Matt. I just don't like these. The intermediate term trend doesn't give me a whole reason or much reason for hope. I don't know. This is a pass for me until it can get back together.
Yeah, I agree with you. It's passed for me for the exact same reasons. And again, I see a little bit of double bottoming action happening at 45. But man, I would love to see a little bit more of a bottoming action at 45, maybe see a little bit more consistency from a price response as well. So stay with us as that navigates that. Let's take a quick peek at Caesars here and Marriott, a couple of discretionary stocks. The gamers are in focus here this week with Caesars, MGM, and as well as Penn National Gaming. Caesars here firing off a little bit of that 110 response. The actual raw numbers are as follows. Caesars actually came in at a pretty nasty miss, negative 110 versus the 18 cent expectation. So real big time miss here. Now they also came in at 2.7 billion versus the 2.7 expectation. That was about a 95% increase in revenue year over year. Little bit of a positive commentary on guidance, but they don't officially provide guidance. A little bit of a stabilization at that 110 level, Tyler. Do you have the interest in this prolonged flag-based pattern on the weekly chart?
Look, say what you will about that earnings miss. The market has not really responded negatively. Yeah, it's clean, man. That's a clean weekly flag.
Can I ask you a question?
Yeah.
On triggering. I see the flag here. You see the flag here. I like and I said the weekly flag before even the daily one because the consistency of the daily was just going to lead to a really good picture on the weekly. You knew the weekly was going to be solid, right?
Yep.
Where would you trigger off something like this, and what type of strategy? Because you had one of those moments, Ty, where like, I don't care what Matt said about the EPS miss. The market is showing me they kind of liked it. You had one of
Yep.
those responses that you saw something. So the question I have is, where would that trigger be for you? And strategy wise, would that kind of be a bull call that you would, and you don't need to detail anything here, Ty, just kind of
Yeah, yeah.
where's your head at?
So trigger this, the thing that's a little tricky on this is it is a little messy on the way down. There's lots of wicks. So you kind of have to plant your flag in the sand and say, look, if you go above here, I'm going to give you a shot, right? Because you could rationalize, well, if I use today's high, then what about these little wicks? And if I use those little wicks, well, I might as well use these wicks. And it's like pretty soon you talk yourself out of not trading it. So
Wickety
it
wick nonsense.
takes out 120, and it's like, well, then you're not trading the flag. So I think I would probably, to clean it up, just go off that weekly chart. I would probably pick this week's high, which is essentially today's high, or maybe these two bars, and then call it good. And then call it good and not obsess over.
Where's your midline there? Because I got one. I'm just going to call 116.
116.
116. That's where intraday. If you look at the hourly chart, that 116 kind of stands out a little bit.
Stands out. Yeah, and it stands out on the weekly as well. So yep.
Yeah. All right. Awesome. Love that. Kind of feel like a bull call spread off this flag. Maybe a little bit of a, break of 160.
If you like it, yeah. If you like it, you like it. Not have to do a bull call, or I would play something else.
That's where I'm at. Is 116. Do a little bit of an out of the money bull call at 120.
Sure.
Something along those lines.
120, yeah.
All right. Let's take a look at Marriott very quickly here. MAR. Marriott, volatile wide range candle, but nonetheless looking at a little bit of a breakout. Marriott comes in at 99 cents versus 97 cents. And I just want to say, hell of a job, Marriott. I mean, to go from not making money 6 months ago, dealing with everything, we all know that the hotels, the airlines, and everything else in the economy, including the individual people, have had to deal with in the last year and a half. To go from that to 79 cents last quarter, 99 cents this quarter, very well done. Very well done, Marriott. They come in at 3.9 billion versus the expectation of 3.8 billion, and that resulted in a revenue increase of 75.1% year over year. Tyler, a lot of discretionary type stocks, cyclical type stocks, when we're dealing with the economy, don't provide guidance because, again, it's very difficult to provide a guidance when you don't know exactly what government regulations are going to be, what's the next variant going to be, things like that. It's just a little bit difficult. But a positive earnings numbers and a positive market response, volatility aside, from a candle perspective, what's your technical read?
This is probably the hardest type of candle to build a trade-off of, because the wicks essentially force you to go intraday. If you don't know how to go intraday, it's tough. So I have to go intraday, Matt, because I can't buy over today's high and stop the low. Like, I'm risking too much, right? So if you really are interested in doing something in Marriott, then you go intraday and you find what levels matter.
It's still tough.
It's not
still
easy
tough.
right now.
That's how I see it. When you got that wide range candle and you got wickety wick nonsense on the top and the bottom side, think about where you're entering. Think about where your stop loss is, and there's no way wherever your target is, it's not going to justify it. It's just tough.
Agreed. Yep.
Yeah. All right, Tyler. Last one I got for earnings, and I you know what, Ty? I love doing earnings roundup, but Wednesdays are my favorite because usually I have to do the fundamental and the technical read on it. And so whereas I can just kind of focus on the numbers, and I just love your technical read, Ty. It just really solidifies my own. So I appreciate that a ton. T-Mobile, TMUS, please. One of the things that we've been looking at recently following some nasty breakdowns in the communication space with Verizon, AT&T, Comcast, we all know those storylines, right? T-Mobile, similar, it was one company reporting that was in that same degree of line today, firing off a little bit here after reporting 55 cents, 54 cents. So a slight beat. You're talking about a slight miss on revenue, though. They do not provide guidance. If this report is happening at the top of the chart, this is a sell. It is absolutely a sell, in my opinion, if it's happening at the top of the chart. But when you're at the low price and your stocks went from 150 to 115 and you've been under fire and you're coming from that the dogs of the Dow territory to a certain extent, if you understand the historical narrative of dogs of the Dow, you understand that this can kind of fire off a little bit, even with some weaker fundamental reports that we're seeing here today on T-Mobile. What does this type of price response following a lukewarm earnings, what does it say to you, if anything?
Well, it gives you optimism and hope if you are a shareholder. Remember, Verizon did something similar where it had a positive response to earnings. It hasn't yet righted the ship because
it's
there's still a lot of
trying though,
supply.
like it's trying.
Correct. And so it does give you hope that, hey, maybe they've priced in whatever earnings deterioration has transpired over the last quarter. It was priced in. It was priced in. That to me would be the overriding sentiment or takeaway, I think, from the response. I think you need to give a little bit of time if you want to trade, especially in light of, look, Verizon gapped up and then it went nowhere for 2 weeks. So
I'm not talking trading in any one of these components. There's a million better trades than Verizon, AT&T, but from that long-term perspective, obviously, when you're talking about these companies, again, Verizon, AT&T, T-Mobile, Comcast, when you're talking about these types of companies, dividend-paying companies, typically dividend-paying companies, cash flow type companies, companies that you're really thinking about longer term. And the low prices historically have been where you want to start accumulating a lot of these types of companies. Well, when you're looking at that, we are seeing the bottoming behavior here. Can T-Mobile add a little bit of that bullish momentum? Those are some open questions. Obviously, T-Mobile was one of them that we were looking at. Can they continue? That's an open question. But that is earnings roundup for today, Tyler. I am looking forward to a conversation that you're going to have with our community in Jedi Options here today as you talk about Amgen earnings response. It was the first company we talked about in earnings here today. We like the reversal potential here. I'm looking forward to see how you would personally navigate that. Take it away, Tyler.
All right. Jedi Options. Today's discussion, an oldie but a goodie. This is a common decision that traders face with deciding, do you do directional versus theta or cash flow? So let me tee up the pattern first, and then I'll kind of walk through strategy selection, right? So Amgen, Matt teed this up earlier in the halftime report. Really decent response to earnings. Here's actually what I like about it. Amgen was on my radar yesterday because of this little breakout. I actually thought it had earnings yesterday, and I had teed up an article writing about Amgen, and then I'm like, wait a second, they haven't even reported earnings because the earnings was last night. So it was impressive to me once I found that out, first of all, that it broke out ahead of the announcement. Now, last night, the initial reaction was negative. It gapped down. It opened lower this morning, but they bought it up again. So I like how the open this morning tested the old resistance zone, and then it popped, right? So I feel like they're just reminding us, hey, no, we broke out yesterday. Like we meant it. Today we got tested and we held that support zone. So I like the action. I like the ascending triangle pattern here. You know, if you look 3 weeks ago, Amgen looks like garbage, right? You've seen a very nice turnaround in the stock here. So I'm encouraged. I think that if this positive earnings momentum continues, maybe Amgen makes a run back up, hopefully towards the 200-day moving average. But it doesn't even need to make money on the trades that I'm gonna give you today. From a trigger perspective, 220 is a pretty significant zone. Old resistance, old support becoming new resistance. If you want further confirmation, I think a break above 220 could be an obvious trigger point. So the question is, by the way, I think someone also might have triggered in today when it broke above yesterday's high. So your choice on the trigger. But the more important question in the topic today is, what strategy do I use to capitalize on this Amgen reversal? And fundamentally, I'm going to draw a picture here. I was thinking about this throughout the discussion today.
Yeah.
I think a great way of categorizing or understanding the difference between a cash flow play and a more directional play, specifically a bull call versus bull put. So think about, and we've done Jedi Option segments on this. There's a trade-off between the risk in the trade, the reward in the trade, and the likelihood that you actually get that reward, right? The probability of profit. And in general, when you do a directional trade, you're usually risking less. Okay, so let's say the risk is low, the reward is high, but the probability of profit is typically lower. Okay, and then when I'm doing more of a cash flow play, the probability of profit's higher. Well, look, you don't get something for nothing, right? Wall Street is a world of trade-offs. If you have a high probability of making money, you're not going to make that much. So the accompanying reward is lower and the dollars at risk are higher. So when I look at the Amgen chart, the directional trade we're going to look at is going to be a bull call. This is a vertical spread. And the cash flow play is going to be a bull put, which is a vertical spread. So birds of a like feather here, both vertical spreads, one's directional, one's more cash flow oriented. Here's the way that I would visualize this, right? The chart shows we're at like 216. Okay, so I got a stock sitting at 216 bucks. With a cash flow play, I'm going to build a strategy where I make money even if the stock just goes sideways. And so the bull put, I'm going to do a December. Let's actually keep the color here. I'm going to do a December 200, 195 bull put. I think right now it's around 60 cents. Okay, 60 cents. So think about that visually with the chart. I'm selling a put at 200. I'm buying a 195 put. Okay, so it's a $5 spread. So you got 200 and you've got 195. Now, the risk, if I get 60 cents, I'm risking $4.40. So if you visualize the distance between these two lines as the spread value or the potential risk versus reward, the lion's share of that, $4.40 is risk potential. And then the smaller portion is the potential profit, just the 60 cents. So risking a lot to make a little, but the probability, I don't know off the top of my head, let's say the probability is like 85%, like an 85% probability of profit. That's one way you could play this trade. Or Amgen, you could say, look, I'll risk a lot to make a little with a high probability. If Amgen goes sideways, I win. If it goes up, I win. If it goes down a little bit, I win. It just can't go below 200, right? I think that when you look at the chart of Amgen, I think that's a decent bet. Like 200 bucks is support. If this earnings optimism really does carry the day and carry the month, this thing shouldn't go down to 200 bucks, right? I think that's a decent bet. If I go structure that trade and I go to December, which is 44 days out, which I think is a great time frame, I sell the 200, I buy the 195. It's actually 72 cents. I had said 60. I guess wrong. It's 72 cents. So my risk is 428 to make 72 cents. Still risking a lot to make a little, but my probability, I'm selling about a 19 delta actually. So my probability of profit's around 81%. Okay, I think that's a legit way of playing Amgen. But you may say, hey, I don't really like, that route. I don't like the high probability, lower reward route. I'm going to go for the gusto on this. Well, you could do the bull call, and maybe you buy the 220 call, and you sell the 225. Again, $5 spread here, so it's apples to apples. That is not going to cost you that much money. It's a cheaper trade. Okay. Again, I would stick with December here. 220 is basically the first strike out of the money. Buy that, sell the 225. It only costs you $1.50. So if you look at the risk versus reward, I'm paying $1.50, which is just a little bit, right? This amount of this gap area, paying $1.50, that's my risk. And I can make $3.50. So the majority of the spread is profit potential. Well, what am I giving up? What's the catch? Risking a little bit to make a lot. Well, the catch is it's got to get up to 225, and the delta is 27. There's about a 27% chance we're going to be above that at expiration. And so your probability of profit, instead of being 80+%, it's about 27%. Okay. Both work. Out of the money bull call, out of the money bull put. Both legitimate ways of playing this. One has lower probability, but more profit potential. The other has higher probability, but less profit potential. And then you just look at the chart and you say, well, if I draw the same kind of lines or boxes, I could do the 200, 195, do this spread here, or I could do the 220, 225 here. And I'll try to get them perfectly symmetrical here. And it's like, what route do you want to take? Which route do you want to take? Both legit. I think they're both fine trades based off of a nice bottoming pattern. One, you're risking a little to make a lot with a low probability. But we say low. I mean, is 225 really that outlandish? No. I mean, it could get there. It's only a couple ATRs away. Or bet it stays above 200. And like I said, have the higher probability route. I like to, in conclusion, I like this as a smart, easy, simplified way of comparing cash flow versus directional and understanding the trade-off with risk, reward, and probability. And then you can make an educated decision. You can make an informed decision. I mean, look, knowing all this doesn't necessarily mean I know what Amgen's going to do and I can predict the future. No, but I can make a much more informed decision, really understand why I made the decision and what the accompanying trade-off is. All right, Matt, come back in. That's Jedi Options.
And Tyler, yet again, a fantastic job. Question I have for you: after you've detailed the bull put and the bear call side of the equation, where do you land on it?
So I'm always, well, two answers. The first default answer is I'm always partial to the credit spreads. Yeah. So I'm always partial to a bull put. However, if I have a portfolio that's already chock full of that stuff, I like to mix it up a little bit, have the occasional directional trade. I don't mind this bull call because you don't even need a stop loss. Your risk is so low. So if you think this thing comes around, I don't mind the bull call spread in this situation.
Especially post earnings, when you have a little bit of volatility crush, you're in that zone where a bull put versus a bull call is still both very viable. But as volatility does start to subside 2 weeks following earnings, those long call options start making a little bit more sense with volatility at the low price. I like them both. Love Jedi Options. One of my favorite things that we do at Tackle Trading every single week, and we do it every single Wednesday with Coach Tyler as he brings the best from an options perspective to our community. Tyler, you also have a trading lab coming up. Take a moment to talk about your trading lab.
Yeah, so it's every Wednesday, 3 p.m. Eastern, we have the Team Phoenix Trading Lab, and we talk about how to make money in the market, how to do different option strategies. All of the things that I illustrate in Jedi Options are fair game in Team Phoenix. You essentially get to take a peek into the types of things that I'm doing, the stocks I'm looking at, types of trades I think are interesting, and get feedback and all the rest. So we have a ton of fun, and you're always welcome to come check it out.
Awesome. Tyler, thank you so much for coming on the Halftime Report here today. For our community, you guys are absolutely the best. We got the Fed coming up very, very soon. I'll have my initial thoughts in the Discord channel here in about an hour from now. And then we will be back here tomorrow on our YouTube programming with another edition of the Halftime Report. And until then, have a great day, Tackle Trading.